Chandra with me right here. Chandra, thank you very much for joining us here on CNBC TV 18. Last year, the same time, when we were sitting and talking about what FY15 will look like, you did sound very optimistic. You said that, it would be much better than FY14, or better. I'm not sort of picking words there. But it's been a difficult year in comparison to what you had laid out. Would you put most of that difficulty down to macroeconomic forces, or would you say that there have been some execution slips as well?
I think if you really see, the slip has been a slight disappointment in Q2 it started. And then it's kind of carried through. We couldn't make up for that.
Sure.
And I would just be able to. I would not be able to just say that whether it's execution or macro.
But you would know,
but
right?
To some extent, I mean, it's because the misses were very slight, very small, and maybe sometimes it is a volatility in a particular segment. I mean, telecom, as I said, has been volatile, and now we feel energy is going to be tough this year because of the oil, etc. But I wouldn't entirely be able to put it on macro. It's just that expectation and our performance is.
No, so if you're not entirely able to put it on macro, then it would be fair to say whether it's telecom or even the problems in your insurance business on the Diligenta front have been difficult to fix, at least intra-year. Maybe you will be now able to fix them here on. You've, I think, indicated that they've bottomed out. I'll get into specifics on that front in just a bit. But does that indicate that, sort of somewhere execution has maybe slowed down? I don't mean it as a criticism, just to understand what the year was like.
No, it is not an execution. It is the nature of certain parts of the business. I mean, Diligenta deal cycles are pretty long, and we don't have a solid pipeline in Diligenta. So that's hurting us.
That solid pipeline is an execution miss.
That's not an execution. It's the demand.
Okay.
It's more a demand.
So you'd say 80% macro, 20% execution, or 100% macro?
Macro and demand.
Macro and demand. Demand is macro.
No, 80% is macro, 20% is demand.
But the demand is macro at the end of the day, right?
Then you make it 100%.
So no execution slip is your assurance.
Execution has been solid.
Okay, fine. As we sit here for FY16, what is your outlook? Will FY16 be better than FY15?
I'm not going to get into that. You know that. I'm going to be.
But FY15, you've admitted, has been a difficult year. So are you saying that FY16 is that difficult?
FY16, the way I would put it is that the environment is good, barring the three headwinds which I outlined, which is volatility in the telecom sector and energy.
And insurance, Diligenta.
Diligenta will still go through a certain amount of degrowth. Barring that, I think the environment is quite solid. India, we have to see. India has done well compared to where we started.
Okay.
But we have to see whether it's going to take off or it's going to be still a slow growth.
Can't tell as yet.
Can't tell as yet.
Okay, so given that you've just laid 80% of last year's blame on macro, when you say that the environment looks good, that means FY16 is going to be better than FY15, at least on the macro front. That's your expectation as we stand here today.
You see, you learn every year. You learn every time what not to do. This is something
what not to do or what not to say at the beginning of the
What not to say, what not to do. Both. So okay. I'm not going to make a statement.
You've had an incredible 5 years at TCS. I know you celebrated 10 years, with a special giveaway to both your shareholders as well as your employees, and congratulations on that. But I'm looking at half of that. 5 years, in FY10, your revenue was 6.3 billion, I think, approximately that. You had about 160,000 employees. This year, you've closed with above 15 billion. So you've gone from 6 to 15 billion, in FY15. 310,000 employees approximately. You've run really hard and fast in the last 5 years. Is it realistic for us to expect that you continue running at that pace in the years to come? Does base effect, size, start becoming a bit of a drag, just so that you can tell us what to expect from this mega-sized TCS as opposed to what the last 5 years brought us?
I know some analysts have also written about base effect, but I don't quite subscribe to that view. The reason for that is in the overall technology business and IT services industry, we are still very small. Our market share is very small. Second, the effect of technology is only getting deeper and stronger in every business. So the opportunity and the addressable space that we have is enormous. And the third is TCS today, in terms of capability, in terms of people, talent, intellectual property, market positioning, is in a much better position to capture many of the opportunities that we couldn't have done several years ago. So given all this, there is no reason why TCS should continue to perform exceedingly well.
Should not, okay, so, okay. Yeah, let me just bear with me for a few minutes. I want to bring up some numbers for you over the last 2-3 years and explain to me why we've seen such a big drop, right? For instance, in a geography-wise revenue growth position, North America grew 27.4% in FY13, 28% in FY14, 13%. I'll admit these are rupee numbers, but nonetheless. Latin America, 40%. 34%, this year 5%. UK 44%, 32%, this year 10.7%. Continental Europe 21%, spiked to 51% in FY14, 19% in FY15. If I look at domains, you know, the top 4 domains that contribute about 75% to your revenue, BFSI grew at 29% in FY13, 29% in FY14, 9.8% in FY15. Telecom 20%, 25%, 8%. Retail, 41%, 34%, 13%. Manufacturing, 37%, 34%, 13%.
There's a pattern here, okay?
Yeah, there's a pattern. These are rupee figures, I'll be clear to viewers as well.
I think that's the fundamental problem. I think you need to, when you're looking at rupee
it's a very big fall, just
No, but it's a lot of it is currency. A lot of it is currency. Let me just give you 2 or 3 statements only to explain this. I think if you look at the constant currency, there is not much of a gap. If you, for example, Europe, if you take what you see as 19% is actually in constant currency terms 28% this year. So if you compare it with a 34% or a 38%, that is also the currency favoring on the other side in the earlier year. But to some extent, I would say that in some years we've had a good growth in North America. North America this year we have delivered about 13% growth, I think. And we have done better than that in the earlier years. And the couple of sectors have not grown well in North America to the extent that they should have grown. But that's not an indication of the future. Our pipeline is pretty strong. Deal closure even in this quarter, out of the 9 deals, 3 large deals were closed in North America. And again, in North America, our size and scale, while it is $8 billion business, it is still very small share of the market. So I don't think that.
No, I get the point that you're still a small piece of the pie.
You need to do this analysis on constant currency.
Okay, so on constant currency terms, on your full revenue figures, in FY12 you grew 23%, FY13 16%, FY14 17%, and FY15 17%. The last 3 years you've maintained it, but in the last 3 years, have we seen some coming off the peak growth rates? I'm just going to ask. I'm not establishing it.
17% is a pretty good constant currency growth. I'll take that.
Okay, so you're
and any market will take that.
So I think my question is this: is the best in terms of absolute growth rate figures behind us now? And you're saying no, that's not the case.
Yeah, that's not the case.
So the best is yet to come for TCS, is your assertion at this point in time.
Always.
So if I connect that with the relatively positive outlook on the macro environment for FY16, I can draw the conclusion that FY16 will be better than FY15. But I'll leave it there. How are you going to fix insurance, the Diligenta problem? What are you going to do about telecom? Energy is not literally in your control in that sense, given where crude prices are. But how is all of this going to change?
Both the energy and telecom, to some extent, nature of the industry today, where they are in their own evolution. Energy, the oil, where it is, you yourself alluded to that. But telecom, the industry itself, especially the communication product segment, when I say telecom, I mean the communication service product segment, is going through a major transformation. They are trying to define their own future in terms of their business. So I think that will play a lot. While it will present a lot of opportunity, at the same time, it will also go through volatility. You are not going to have a uniform growth across the client segment, across the markets, and so on and so forth.
So have we bottomed out on insurance and telecom, or is there still some bad news in the pipeline?
Telecom, I'm not going to be able to say that because what I'm saying is that suddenly you'll see a growth, suddenly you'll see a dip.
So lots of volatility.
That's the point I'm making in
fair enough.
telecom.
That's fair warning.
And insurance on the services side, excluding the Diligenta, we have bottomed out. It will continue to do well. It did reasonably well. It did about 11% last year. I kind of separated it out so that the market could see where we are excluding Diligenta.
How do you fix the Diligenta problem?
Diligenta is a long cycle business. It will do very well because it's a very, very solid platform, very unique platform, has very modern technology, but it will take time because the deal cycles are sometimes 2 years also, sometimes 18 months.
So it could take all of FY16 to fix that problem?
It could potentially.
It could. Okay, are you talking us down? Because last year when you talked us up, you had to sort of revise the outlook 2-3 times in the year, so to speak, and therefore you sound very muted right now about what the year is going to look like. And I can't make out if that's because you feel not very confident about the year, or you're just sort of compressing our expectations.
I've given you enough qualitative comments. I'm just not guiding to your number.